In this video, I wanted to introduce you to one of the bullish investors of Alibaba stock, or one of the most bullish investors in Alibaba stock, and that is Alibaba itself. That's right. Alibaba has been spending billions of dollars repurchasing its own stock. It's, in my opinion, one of the most bullish investors in the company. And I'm going to elaborate a little bit on what this means for investors that are looking at and considering Alibaba stock and discuss whether or not this is a smart move from the company's management, repurchasing several billion dollars of its own shares. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So Alibaba is saying that for the September quarter, we repurchased shares of a total 4.1 billion US dollars. Combined with the $5.8 billion repurchased during the June quarter, we've spent approximately $10 billion and achieved a 4.4% net reduction in share count for the first half of the year. So they've spent over, or roughly, $10 billion buying Alibaba stock. Now, I was hard pressed to find another investor that purchased this many shares of NVIDIA stock in this short amount of time, roughly $10 billion worth of Alibaba stock. Now, this isn't a new thing either. Last year, they purchased significant sums of stock, and on a percentage basis, even more than this $10 billion. Last year, they repurchased 5.1% of shares in Alibaba stock in 2024. So combined for the 2 years, well, and 2024 is not completed yet. They have another quarter which they have yet to report on, the quarter that ends in December. They have repurchased close to 10% of their shares outstanding, 9.5% of their shares outstanding. That's a huge amount of repurchases in less than 2 years. And this is a strong signal to the market that Alibaba feels its stock is undervalued. Additionally, they still have $22 billion of authorization to buy back even more shares. So you shouldn't be surprised if they spend another $4, $5, $6 billion in the next quarter buying back their shares, as long as valuation remains attractive. And valuation, in my opinion, has been very attractive all year long in 2024. Even after today's jump in stock price following the announcement of more fiscal stimulus, Alibaba's share price is trading at a forward PE of 9.6. That's compared to other e-commerce stocks that are trading at valuations that are 2 to 3 times higher than this. If you look at Amazon, Mercado Libre, Sea Limited, etc. These e-commerce companies, they're not only e-commerce companies, right? They have cloud businesses, financial services, and other things. So it's hard to compare apples to apples here, but just similar companies. They're trading at 2 to 3 times the valuation of Alibaba stock. And so Alibaba stock is trading at a relatively cheap valuation because of the increasing risks of Alibaba. Not only is it operating in China, which has increasing geopolitical risks, given its tension with the United States and the potential tariffs coming in that will make it even more difficult on the Chinese economy if they are implemented. But on top of that, the growth inside China has been tepid and slowing, and there are troubles brewing inside the property sector. And so those risks have created this diminishing valuation. I can share with you Alibaba's 10-year history here, and you can see for the better part of the last decade, the company was on an excellent growth trajectory. That is until 2022, when that growth slowed and hit a wall. And it's been, I could say, the Great Wall of China. But here you can see that slowdown, and it's still roughly where it was 2 years ago in terms of trailing 12-month revenue. So growth has slowed, sharply stopped. And that's a result of several factors, including slowing economic growth in China and rising competition. Competition has been fierce and increasing. Alibaba's management has alluded to this several times, how difficult competition has been in the region. And competition gets worse when overall macroeconomic growth slows down. because businesses have the capacity and they don't have the area to expand into new customers, new customer segments. That part is slowing, so they have to fight with each other for existing customers because there isn't new customers entering their business categories. That's been a very difficult time for Alibaba, and it's been very difficult for Alibaba to reignite growth. And still, though, even though their growth rate has slowed down, the company still generates very strong cash flows and operating profits. In the trailing 12 months, they generated $21 billion in cash flow from operations and another $16 billion in operating income. So while the growth has slowed, they're still generating profits and strong profits in that area. So I shared with you one form of valuation to determine if a stock is expensive or cheap. You look at the forward price to earnings ratio, and that incorporates the market price divided by the earnings per share expected over the next 12 months, and you get a picture of how much you're paying for the earnings the company expects to generate. Another way to value a business is by doing a discounted cash flow valuation model, which I have done for Alibaba stock. I did this on December 2nd, and I posted a video a couple of days after that. And in my calculation for how much Alibaba's shares are worth, using my discounted cash flow valuation model, I came to the conclusion that Alibaba shares are worth $153. Now, if you compare that with the current market price of just $93 per share, you can see that this valuation method also points to the fact that Alibaba stock is undervalued. So all of this goes to highlight management making all of these purchases, $10 billion of repurchases just in the last 6 months, and they're planning to spend another $22 billion if their shares are priced in this similar range. And it signals that, management has done these calculations, and whatever methods they use to come to the conclusion, they've come to a similar conclusion that I've come to in feeling that their shares are undervalued. So they're going out and spending tens of billions of dollars to buy back their stock. This is a management team putting their money where their mouth is. You hear a lot of management teams, and almost every CEO will go out and promote their company and highlight how they feel their company is undervalued, right? Almost every CEO, will do that. They'll go out and they'll talk about how they think their shares are undervalued. But a smaller percentage will actually go out and spend billions of dollars buying back their shares. And those are the ones you can really trust, that believe their shares are undervalued. Alibaba being one of them, spending tens of billions of dollars. So understandably, they are the most enthusiastic, the most bullish investor in Alibaba stock, and they continue to spend this money. As a reminder, I've had Alibaba stock rated as a buy all year long. I still think Alibaba stock is a buy according to my calculations, which I shared with you. I feel that shares are undervalued. Now, there is considerable risk in Alibaba stock, and most of that risk is incorporated into the valuation, the geopolitical risk, the slowing economic activity in the region, all of which investors should consider before making a decision on Alibaba stock. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.